Only one person? Okay, ma. No problem. I'll start the class, ma. Okay, in the previous class, I don't know you have attended for the class or not. In the previous class, I have explained you about the written on portfolio, risk on portfolio with the probability and without probability, and I have given from here the concerned person also. Will anyone is going to join? Still anyone is going to join? Hello? Okay, fine. So in the previous class, I have explained about the written on portfolio, risk on portfolio with the probability and without probability. Probabilities also are given. About the dividends capitalization, I thought also have explained to you people. And I forwarded some notes to concerned faculties also. So if you want, you can take the notes also. And today we'll be discussing CAPM theory and CAPM, some of the problems I also have explained. But here I'll explain some other problems on CAPM. If you look at the question, so this is a formula for CAPM, written on portfolio as per the CAPM. RF plus beta into RM minus RF. So what is RF? RF is a risk-free rate of returns where we have been including the government securities and all those things. RM is written on market. Beta is the market sensitivity which we have been measuring. The measurement of market sensitivity will be measuring with the help of beta coefficient. So RM is written on market. RM minus RF is going to give you risk premium. Fine. So with the help of one formula and with the help of one example, I'll explain it. You look at the questions, considering that Mr. Prasad following several investments, the risk-free return is 6.75% and the expected return of the market is 12%. And what should be the required rate of return for each investment under the CAPM returns? So here with this information, we are going to evaluate the CAPM return. That is securities, how many securities they have given? A, B, C, D, E securities, and the beta already calculated value they have given 1.20, 0.8, 1.56 and 1.25. Okay. So what is the formula for the beta CAPM? RF plus beta into RM minus RF. So RF in the problem already they have mentioned 6.75. Beta in the problem they have mentioned. And written on market, what is the written on market? They have given the expected written on market 12% they have given. Is it not? So for security A, this is the value. That is RF is 6.75 plus beta is 1.20. 12 minus 6.5. So return of CAPM of security A is 13.05. Similarly, for security B also we will be calculating with the help of substituting the values, we will be getting 10.95 and security C 14.63 and security 3 9.87 and security E is a 13.31. So this is the overall CAPM return of A security, B security and C security. Very easy problem. Definitely if you are expecting any problematic means from this unit you can expect this problem CAPM. Okay. Next question we'll consider. If the risk-free rate is 20% and the expected return for the BSC index is 18% and the risk measurement by the standard deviation is 15%, how would you construct this efficient portfolio with the help of 16% expected return on the market? Okay. So what are the given values? They have given risk-free return 10%, they have given return on market 18% and risk on security 5%. So at 16% rate of return efficient market happens, we have to construct. So RF is equal to W into RM plus 1 minus RF. They have given the efficient market hypothesis. So we'll be considering the weights. With the help of weights, we will be evaluating the things. And after evaluating the things, we got the 75%. So therefore, we are going to get the 75% fund should be replaced in the market portfolio because they are risky assets. And the balance should be invested in the risk-free asset. Okay. So then after evaluating these funds which are diversifying, then we will be evaluating the risk on portfolio, RF plus risk into RM minus RF divided by risk on market. Here formula slight variation. Why we have given slight variation in the formula? Why? Because they are considering the efficient market hypothesis. They are considering the efficient market hypothesis. Next, the following data which is related to on security X and security X and security Y with the help of coefficient of correlation with the market and standard deviation also we can evaluate the CAPM. So if you look at coefficient of correlation for X and Y and standard deviation for X and Y, they have given return on market 0.25, risk free is 0.05 and risk on market square is 0.01. So with this, we have to compute the beta for the security X and Y and we have to compute the beta for equal weighted portfolio of security X and Y and compute the average rate of returns. So we have to evaluate the beta for X and Y as well as separate beta we have to evaluate when we are diversifying the portfolio equal to X and Y securities and average return. So risk on market square they have given 0.01 and risk on market we will be getting 0.1. Okay. Calculation of beta for the security X and Y. So for formula for beta is equal to sigma X by sigma M into sigma X into market. Okay. So we'll applying the values in the formulas. We'll be getting the beta of X and beta of Y. So we got beta of X on 0.196 and beta is 1.18. Average return is the formula for the average return in the previous class I have explained to you people. R1 x1 plus R2 x2 squared. So risk we are measuring with the help of standard deviation. So R1 is nothing but we can consider W or R1. W is nothing but the weightage which we have been taking. So here the question what they have given, we have to evaluate the beta for equally weighted portfolio. So here we have been taking the equal portfolio that is 0.5 and 0.5. Okay. So after getting the equal portfolio, we will be evaluating the beta. So equal portfolio తీసుకున్న తర్వాత we got these risk on security 0.21 and after applying in the formula we will be getting 0.197 is a return on portfolio when we are been diversifying the weights equally. When we have been diversifying the weights equally, we will be getting this portfolio. Fine. The next question. This is about your CAPM. And next one is your arbitrage pricing theory. So what is the meaning of this arbitrage pricing theory? The next efficient portfolio which will be available in the hands of the investors is your arbitrage pricing theory. So this is also another method where we are evaluating the risk on portfolio. This is one more method which we have been there. So it is a method where the securities market returns can be divided into three types. That is your macro, fundamental and statistical factor. So what are these macro factors which will be using observable economical time series such as the inflation and interest rate risks, and we are measuring as a perspective shocks to security returns. So fundamental factors models use these returns to portfolio associated with observed security attributes such as the dividends yields, book market to ratios and industries. So this arbitrage pricing theory is an alternative for the capital asset pricing models, which is explaining the returns on assets and the portfolio. It has been developed by the famous economist Stephen A. Rose in the year 1970 to overcome the shortcoming of the CAPM return. So this APT is a multi-factor technical models, which is entirely based upon the relationship between the financial and expected returns and the number of microeconomical variables that is being captured systematically. So this model is entirely designed to capture the sensitivity of the assets returns to change in a certain macro economical variables. So investors and the financial analysis can use these results to help the price securities. So according to these APT, the arbitrage hopes to take the advantage of any deviations from the fair market value as well as they are going to assume the markets are perfectly efficient. This theory is going to provide the analysts and investors with a high degree of flexibility regarding the factors that can be applied to the model. There are various numbers and different types of factors which will be used for the analysis choice. So these two methods, we are having two methods under this ABT. So what are the methods? I'll tell you. one factor model and two factors model will be there. So under these ABT, we are be having a one factor model and two factor model. Simply one factor model, two factor model, nothing will be there. One factor model, in one factor models, we will be using the one beta, and two factor model, we will be using the two betas. Betas are nothing but your weights we can consider. So here, if you look at this is a formula for this arbitrage RF plus lambda 1 beta 1 lambda 2 beta 2 lambda 3 beta 3. So how many factors models we'll be using? So in that cases we'll be using the betas. Okay, so E is nothing but your expected rate of individual assets. RF is the risk free rate of return. Market price is the first factors, and the market price for the second factors, market price for the third factor. Beta is a sensitivity factor for the stock 1, sensitivity factor for the stock 2, and sensitivity factor for the stock 3. This is about your formula of expected returns for the arbitrage pricing theory. So with the help of weights, we can get, this is a formula. So with this, we'll calculate a small solution. See, the relocation coefficient of two stocks and the market price are given. Factors, 1, 2, 3 factors. Lambda 0.09 minus 0.03, 0.04. Stocks for the beta 1 and beta 2s. For the stocks, beta 1s, 1, 2, 3 factors ki, 2, 3 factors ki. With this, we have to use the APT models, and the risk-free return is 6%. What is the expected return for the portfolio? Calculation of expected return on arbitrage asset is equal to stock 1 beta 1s. What are the stock 1 beta 1? 0.5 and 0.5 and 0.7. These are the betas for the factor 1, factor 2, and factor 3. So for this, simply we are applying in the formula risk free 6%. Beta 1 is 0.09, lambda is 0.09, beta 1 is 0.5, and the lambda is 0. Minus 0.03 into 0.05 plus 0.04 into 0.12. This is for the stock 1, and next one stock B also we will be considering with using the same formulas, and with this, with the help of weights, we can calculate with the help of 0.05. This is expected rate of returns on the arbitrage pricing theory. Next, portfolio evaluation means whatever the portfolio till now we have evaluated, return on securities, risk on securities, with the probability, without probabilities, how this portfolio evaluation means whatever the portfolio we have been evaluated and analysis, whether these portfolios are being properly evaluated or not. Means we have selected in A security, B security, and C securities. The allocation of funds which have been measured and we have been allocated those funds, whether we have been evaluated in a proper way or not, we have been analyzing with the help of portfolio evaluation. So whenever we're considering a portfolio evaluation, the perfect statistic, financial technique is your mutual fund portfolio evaluation. So for considering the mutual fund portfolio evaluation, three methods will be considering, that is sharp, stensis, and Jensen's. SPTP, JP. These are the perfect and powerful weapons which will be there for evaluation of portfolio. So first, we'll consider this Sharpe's ratio, Jensen's ratios, and Tenses ratio. SPTP, JP. They will be considering as SPTP, JP. Sharps ratio. So there are several limitations with the use of these Sharp ratios due to the certain assumptions and the way which have been defined. Some of the important limitations which we'll be considering for the Sharps is your Sharps cannot be determined, differentiate between the intermediate and the conjunctive losses at the risk measures which is independent and the order of various data points. So here, whenever they are been evaluating the Sharps models, most of the parameters which are in the backwards looking for the accounts and the historical data and the volatility of the measures which we'll measuring with the help of these things, we will be evaluating the Sharps ratio. The formula for the Sharps ratio, if you look at the formula for the Sharps ratio, RP minus RF into sigma P. So RP minus RF into sigma. What is RP? That is nothing but your return on portfolio, risk-free, and beta of security. Beta of the portfolio. Risk of the portfolio. So here the ratio which is going to measure the excessive return of the portfolio per unit of the total risk. Graphically, whatever may be the things which have been measuring, so we are measuring with the help of return on assets which have been compensating the investor for the risk and the whatever the risk they are been bearing. Investors mostly oftenly advise to choose a securities with a high Sharps ratio. So this ratio is going to measure a continuation of its works on the capital's pricing models, and but it uses a total risk which is instead of beta and comparing the portfolio. If the Sharps ratio of the portfolio or the security is greater than the Sharps ratio of the market is, then the assets are earning more than that of a risk premium which is required for the capital market. So this is a formula for the Sharps ratio, and with the help of the small problems we can evaluate the Sharps ratio. Suppose that the 15-year annual return for the BSE Sensex is 10% and the standard deviation is 18%. The average annual return on the treasury bills is 5%. We have to require to evaluate the performance of the three portfolio managers with the following 15 years results. Just 1 minute. Fifteen years annual return for the BSS Sensex is 10% and the stand deviation is 18%. The average annual return on treasury bills is 5%. With this information, we have to evaluate the performance of the three portfolio with the following 15 years results. So the managers are Anil, Bhaskar and Chaitanya. These are the annual returns for this particular investors, and the portfolio of that is risk on portfolio is 0.11, 0.21, 0.27. With this, we have to evaluate the SP ratios. What is the formula for SP ratios? RP minus RF divided by risk on portfolio. What is written on portfolio for these? 13%. That is 0.13 minus 0.05. That is a risk on written on market. In the problem they have mentioned, written on market is next risk on portfolio, that is in the stand deviation they have given 18%. Okay. For the market, we have evaluated, and for the Anil, we will be evaluating 13% minus 0.0 divided by risk on portfolio 11%, 0.11. And for the Bhaskar, 17 minus 0.05 divided by 0.21. And for Chaitanya, 0.18 minus 0.05 divided by 0.0. So this is all about the Sharps ratios of these market, Anil, Bhaskar and Chaitanya. With this information, we have to give suggestions to the investor. That is, all the three managers have been exceed the market as shown in the Sharp ratio. So they have exceed. Actually, what is the market return? That is only 0.27. That is 27% is the market return. But if you have evaluated the things, just normal evaluate. Just if you look at the investors portfolio for the Anils, they are having a return of 72%. Bhaskar, that is 0.05, that is, and the Chaitanya 0.4, that is 48%. So here the best performance has been given by the manager Anil as a Sharps ratio of the portfolio is the highest. So here with these annual returns of portfolios, they are going to manage the manager Chaitanya where be the highest. Thus it is found that the best portfolio is not necessary, but the one with the highest return is the adjuster. So here we will be considering the risk adjuster is we are considering it's very important to accept. This is about your Sharps model ma, and the trenches model. So if you look at the formula before explaining the theory of this, if you look at the formula, the same formula, the numerator will be the same, will be the same for the Sharps and trenches, that is RP minus RF. For trenches, we are being, instead of risk on portfolio, we are being evaluated beta of portfolio. For SP, if you look at the formula for SP is RP minus RF divided with sigma of P. And for trenches, RP minus RF divided by beta of P. Is it not? So small variation will be there for the Sharps and the trenches. So he is the first researcher who has been computed the measure of the portfolio performance, and he proposed a risk-adjusted performance measures in the year 1965 and became the first researchers to provide the investors with a comprehensive measure of the portfolio performance, and he will be taking into a considerations. The formula which we are using for this is the formula. uh, RP is nothing but a realization return on portfolio, risk-free rate of return, and the beta coefficient for the portfolio. Fine. So how we have been considering the trenches models means the greater the value of the trenches measure will be the better performance of the portfolio, and all the rational investors who would like to maximize the returns will be using this trenches ratio. However, if the ratios is just ranking the criteria and does not quantify the value added, then there will be active portfolio managements will be there. So with the help of the small examples, we'll consider these written on portfolio by the trenches method. Yes, ma, is my voice is clear? Is my voice is clear? Anyone can text me. Ah, okay. Thank you. Thank you. At least one is giving a reply to me. Fine. With this example, suppose the 10 years annual returns for the NSE Nifty is 10% and the standard deviation is 18%, and the treasury bills are nothing but your government securities. Government securities, the treasury bonds, ni risk-free rate of return and antamama. In the problems, they will not at all mention risk-free and mention cheyaru. So with the help of these words, we have to evaluate those are the risk-free, that is treasury bills is 5%. With this, we have to evaluate the performance of the portfolio for the 10 years results. So managers already have given the similarly how they have given for the Sharps ratios. Ram, Robert, and Rahim, an average rate is 10%, 15%, 16%, and the beta for these 0.95, 1.05, 1.20. So with this, we have to evaluate the trenches ratio. First, we'll evaluate with the market. So what is the return on market they have given? 10% they have given, and the risk they have given 0.05 divided by beta of that particular market is 1. So return trenches ratio for the market is 0.05. Similarly, we have been applying the same formula for the Ram, Robert, and the Rahim. So with these the values, we'll be getting the returns 0.05 to 0.095, 0.095. So if you observe the portfolio which have been performed better for the risk adjusted basis has not been giving the highest total return. So if you observe the portfolio which have been performed, it's a better risk adjusted basis which has not yet been given in the highest returns. So these with this information we can evaluate the trenches ratio. So SP, TP, JP. So on the last one is your Jensen's ratio, that is differential returns also we can call, or else Jensen's measure also we can say. So these Sharps and Trenches measures are the tools which is going to ranking the portfolio of the funds on the basis of their relative performance on the risk adjusted basis. So the third measures which we have been naming as the Jensen's ratios is a developer for the Michael Jensen's, who is providing the absolute measures of the risk adjusted returns. He will be evaluating the performance of mutual funds in the year from the year 1968 itself only. So here, this alpha is going to use the CAPM as a benchmark to measure the return on portfolio, and alpha will be using to determine the abnormal risk returns, which will be helping for the securities or the portfolio for the overall theoretical equipments. So the formula which we have been using for the Jensen's ratio. So how the formula will be there for the CAPM returns RF plus beta into RM minus RF. In the same thing, Jensen's will be there RF minus RF plus beta into return on market minus RF. The same similar formulas we'll be using plus with the slight variations without including the risk premium. This is the formula. With the help of example, the annual returns of the market portfolio is 10% and the standard deviation is 18% and the treasury bills is 5%. With this information, you have to evaluate the Genesis alpha. So if you look at the managers are Naresh and the average returns are 11%, 16%, 16% and the beta values is 0.9. So if you apply in the formula that is RF plus beta into RF minus RF, we'll be getting the different values. So for Naresh, we are getting a 9.75% and the Ramesh 10% and the Mahesh is 11%. So with this alpha, we can evaluate the return on portfolio. So basically, there are three methods for the return on portfolio, that is Sharpe's ratio, Trench's ratio, and Jensen's ratio. The return on portfolio is going to give a combination of these three portfolios itself only. These three ratios only we are going to evaluate with the return on portfolio. Okay. The difference between these portfolios are your risk-adjusted measures, average advantages and disadvantages we'll be considering. The first advantages for the Sharpe's ratios, it is simple and initiate to benefit cost comparison of the risk-free rate of returns and is linked conceptually to the CML and capital market theory and simple to calculate, the widely used in practice. This disadvantage is yes, it permits only relative assets of performance of different portfolios and difficult to interpret and access the statistical significance. It ignores the diversification of potential of portfolio. Coming to the trends, simple and initiative benefit cost comparison of the risk rate of traders and linked with conceptual with SML and capital market theory. Relatively simple, calculating and widely used in practice. Disadvantage permits only relative assessments of portfolios, interpret the results same as usual, the same thing will be there, and it always ignore the unsystematic risk of portfolio. And coming to the alpha, most rigorous risk-adjusted process separating the systematic and systematic components can be adopted to either CAPM or multi-factors models and the risk-free. And it will be also the disadvantage of the significance can be vary greatly depending upon the significance of the generating returns and the models. So these are the slight difference will be the advantages and disadvantages will be there with the. Next, we'll consider some other examples with these. That is, considering a mutual fund A and market indexing, the following information is available for regarding the performance of these past experience. So the parameters are risk and beta standard deviation they have given. Mutual funds and mutual fund market index they are also given. With the help of this formula, simply we can be using the return on portfolio beta of P into RM minus RF, beta of B into RM minus RF, and RM minus RF they have given. So for this we can using this formula.
Waiting, waiting.
Portfolio అయిపోయింది. Next, how we are going to managing the portfolio means with the help of these are the reasons for managing the portfolio through the managed portfolio. First one is availability of time, smart enough, and spending a time over other activities, investment plans, and learning from the professional managers. So here first we look at the availability of the times. The main reasons to let know someone that who is managing a portfolio is that client has a little and no time to manage a portfolio. In that cases, with that cases, we will be using the fund manager. We will be approaching the fund managers, and we are not at all smart enough that how the market is going to fluctuate, when the market has to be raised, when the market is going to done. In that cases, that for the reasons we will be approaching the fund of manager portfolio. That is, investors may think that they are not enough much smart enough to manage their money. So that cases, in that cases of investors might think that the portfolio managers are smarter than how they are been doing the better equipment for their portfolio and spending the time on other activities. So investors always they'll be spending on earning their incomes with other activities, or they will be busy with their profession and all those things. So in that cases, it will be not helpful, and they're not having a sufficient time for the investor to diversify those portfolio to diversify their funds. So in that cases, they will be spending the time for the other activities. So that they will be approaching the fund manager. An investment plan, they will be not having any kind of a proper plan. They will be having a knowledge that this is this much of the amount we can raise for the things, but they don't be having the investment plans. In that cases, they will be approaching the fund manager. Okay. With some of the examples also I'll explain. Some other extra problems I'll explain to you people. We don't know which method we can get. So if you look at the question, Sam is interested in investing in mutual funds in India, and he has been an active investor in the capital market and has earned a handsome returns for many years. After intensive study and the discussion with his friends, shortlisted the following five mutual funds or approaches for it. You have to advise with this. So ICICI Prudential's blue chip funds and HDFC top 200, SBI Magnum, Sun and FNCs, and Sudram Growth. You are an investor's consult to give Sam sound advice. You can collect the information. So with this information, we have to give a suggestions to the investor. So ICICI Prudential's return standard deviation and beta, HDFC's, SBI, Sun FSC, and Sundram. These are the information they have given. So return on risk-free asset is 5% and return on market is 16%. With this, we have to evaluate these mutual funds using the sharp stresses and chances and commenting whether the SAM has made any acceptable selection for the base. So if you look at the formula for the SP, that is Sharpe's ratio, RP minus RF divided by risk on portfolio. For ICICI, return on portfolio is 19% minus risk is RF is 0.5% and beta is 6. So 2.33 for ICICI, for HDFC 2.52, for SBI 3.12, and for Sun 1 and for Sundaram company 2.60. Similarly, in the same cases, we'll be calculating the trenches ratio, that is RP minus RF divided by beta of B. So here we have been using the beta of B. So 19 minus 5, 0.8, 22 written on portfolio for the HDFC 22, written on portfolio for SBI 17, written on portfolio for the Sun 11, written on portfolio for Sundaram is 8. 5%, 5%, 5%, 5%, 5 is risk-free return, and the beta is 0.80, 1.15, 1, 0.72. And this is the information which is given in this table. If you look at this table, you can get. Okay. Here I am. So by applying the values in the formula, we will be getting Trenches ratio 17.50, 14.78, 12, 8, 10. This is a Trenches ratio. And Jensen's alpha is RF plus beta into RF minus RF. Similarly, the same values will be incidenting with the in this formula ICICI, HDFC, SBI and Sun. And these are the returns for these Sun, ICICI and all those things. So if you look at the ratios here in the tabular information, they have given the Sharps ratios. 2.33, 2.52, 3.12, 1 and 2.60, Trenches 17, 14, 12, 8, 10, and Genses 5, 4, 1, minus 1, 0.7. If you look at out of the 5 funds, Sun and FNC Value Fund and Sundaram Growth Fund are showing negative values as per the Genses. So as per the Sharps ratios and Trenches ratios, these two funds are showing less performance compared to the other remaining funds. So hence the SAM has not made any kind of acceptable selections based upon the past performance. That or why? Because these are the two companies which is showing the negative returns, and for the other portfolio, they will be having a less compared to that of a other portfolio. Okay. And with the help of another examples also, we can say the Winley Fund Treasury Bills and the S&P 500 having the following returns, and for the past 5 years, Winley Funds is returns is 7, 5, minus 5, 13, 11 and 15 for the 5 years. And the government securities or treasury bills, or we can call risk-free, is 5%, 9%, 7%, 6% and 8%. And the return on market, these are all return on market. S&P 500 అనేది అది మనకి మార్కెట్ ఒక ఇండెక్స్ అన్నమాట. సో రిటర్న్ ఆన్ మార్కెట్ is 0.5, minus 4, 10, 9, 12. Determine this Willis funds alpha and the beta coefficient for the 5 years for the period of time. So the problems which is be given there, they have given this for the 5 years prime. These are the returns which you are be giving, that is 0.5, x and y with help of x variables and y variable we can consider. And we consider this x as the independent variables and y as a dependent variable. Okay. So 0, minus 13, 3, 3, 4 and y 2, minus 14, 6, 5 and 7. So x into y, if you'll multiply this x into y, we'll be getting, these are the values, 0.0 into 2, that is 0, minus 13 into minus 14, 182, 3 into 6, 18, 3 into 5, 15, 4 into 6, x square. These are the values, we are going to square it. And after applying, calculating this, we have been applying in the beta values. After that, we'll be getting this, the value, that is alpha and beta value. Beta is 1.26 and alpha is 1.93. The alpha is positive. Here we got the alpha is positive and the Winley performance risk on portfolio is adjusted period of time is always a negative one. Higher the beta and higher will be the security, higher will be the risk will be there for the beta coefficient. Okay, ma. Most probably all the problematic parts I have covered, ma. I don't know you. I think you have not yet attended in the previous classes. We were 16, not 9. Okay. In my previous classes, Kalyani, Sharma, some other persons have been me. Okay. I think you have not attended my previous classes. With this, I have completed all the practicals parts, ma. If you have any doubts, you can call. You can ask, ma. If you have any doubts, you can ask. Or else you can just text me. Any doubts, ma? If any doubts, you can ask, ma. You can just text me. I'll clear your doubts. I'm waiting for your doubts. If you have any doubts, you can just text me. Yes, ma. Any doubts? No doubts means you can leave the class, ma. No doubts, you can leave the class.
Namanya cocok berarti sama dapat ternyata.
Fidra.